If you're selling on Shopify, there are 3 common Shopify tax mistakes we see that you need to avoid. And it all starts with a basic assumption that Shopify understands your entire sales tax picture. Well, it doesn't. Shopify is an incredibly powerful e-commerce platform. It does a lot of things very well, and compared to many systems, it makes sales tax easier to manage. But easier does not mean automatic, and it definitely does not mean complete. Shopify can only see what happens inside the Shopify ecosystem, and your growing e-commerce business is more complex than that. That gap between what Shopify sees and what's actually happening across your business is where the 3 most common Shopify tax mistakes are made. And mistake number 1 is letting Shopify's nexus suggestions drive registration decisions. Shopify will surface states where you may have sales tax nexus, and to be clear, Shopify does know whether economic nexus thresholds are met based on sales that run directly through the Shopify platform. That part is working as intended. The issue is that Shopify does not always have visibility into your entire sales tax picture. Shopify doesn't know whether some of those sales came from marketplaces that already collected and remitted tax on your behalf, whether activity in a state was temporary or tied to a short-term spike, whether inventory movement or fulfillment created brief exposure, or whether registering in that state is the proper strategic move right now. Shopify can surface data. It cannot interpret context. Without that context, it's easy for sellers to assume that a Shopify suggestion equals a requirement. We routinely see sellers in states where all sales were marketplace facilitated, Nexus existed briefly but no longer does, or the compliance burden outweighs the actual risk at that moment in time. Once you register, you're usually locked into ongoing filing obligations, 0 returns, and long-term compliance work. This is one of the most common ways Shopify sellers quietly over-comply, and it almost always starts with good intentions. Mistake number 2 is ignoring marketplace facilitator rules when using Shopify. Many Shopify sellers don't sell exclusively through their Shopify storefront. They're also selling through marketplaces like Amazon, Walmart, or Etsy, sometimes all at the same time. Shopify can show you gross sales across channels, and in many cases it does a pretty good job of identifying which orders came from marketplaces versus direct Shopify sales. The challenge is that from a sales tax perspective, it's not always obvious how those marketplace sales should be treated. In many states, marketplaces are classified as marketplace facilitators, meaning the marketplace, not you, is responsible for collecting and remitting the sales tax on those transactions. The mistake we often see isn't that sellers don't know marketplaces exist. It's that they don't know how to interpret marketplace reporting inside Shopify when it comes time to think about registrations and returns. Without a clear understanding of how marketplace sales factor into compliance, a few common issues show up. Registering in states based solely on marketplace volume, even though the marketplace is already remitting the tax. Including marketplace sales on returns in a way that doesn't align with state reporting requirements, or misinterpreting gross sales reports when determining who actually owed the tax. From the seller's point of view, the data looks reasonable. Shopify is showing sales, platforms are collecting tax, and reports appear to line up. From the state's point of view, however, things can become inconsistent if marketplace activity isn't interpreted and reported correctly. Marketplace rules vary by state. Reporting expectations vary by state. And while Shopify provides the data, it doesn't tell you how to apply that data for sales tax compliance purposes. That interpretation still requires sales tax knowledge and intentional review. And mistake number 3 is treating Shopify tax reports as filing ready. Shopify provides tax reports, and those reports are useful. They're excellent for understanding what happened at checkout. The mistake is assuming that those reports are automatically ready to be used to file sales tax returns. In most cases, they're not. Before returns can be filed accurately, Shopify tax reports often need additional work, such as removing marketplace sales that should not be reported, validating exempt or non-taxable transactions, aligning Shopify reporting periods with state-specific filing periods, and accounting for state-specific nuances that don't map cleanly to Shopify's reports. Shopify is optimized for checkout accuracy. States care about compliance accuracy. Those two things are related, but they are not the same. When sellers skip this reconciliation step, that's when issues tend to surface. Numbers don't tie, notices start to arrive, and CPAs are left trying to reverse engineer what Shopify was actually doing. But if you think these 3 common mistakes are bad, just wait until you see the #1 Shopify tax mistake that we see. And for that information, click or tap on this video. And remember, when in doubt, always consult with a sales tax professional.